Hello. I'm on early because I'm doing a technical check. Um, I like to do this because this system tends to cut me off ahead of time. So I'm just going to get onto LinkedIn and make sure that you guys in my LinkedIn market can see me. All right, I'm on LinkedIn, uh, YouTube, and Facebook, but LinkedIn is my main market. This episode of Boss Move starts at 11. So I'm going to mute my mic and turn off my screen. I'll see you guys in a couple. Hello, everyone. Welcome to Boss Moves. There is a definite lag between when I speak and when it appears on uh, the LinkedIn. So there's also a lag between when I take an action here and when it happens on LinkedIn. Sometimes I go too fast and I might cut myself off. So now I'm going to add a little buffer at the beginning and end of every session, uh, so to make sure you guys get every good tidbit that I throw out there. Caution: 8 value traps to avoid in small business. Welcome to Boss Moves. There are 8 common drivers of value to work on and accelerate the value of your business. I discuss these 8 drivers from the eyes of Warren Buffett. Sort of. I kind of quote Warren Buffett throughout. Hi, I'm Graham Woods, a financial consultant specializing in business value and wealth management. Imagine having a clear strategic plan that not only grows your business and income, but also secures your financial future. I help business owners to create, manage, grow, protect, access, and transfer their business value. This live stream is about helping you to make boss moves using my Evergreen Value Management System. Boss Moves is about the strategic management of your business value and risk to support your personal financial goals. By integrating the business value estimates into comprehensive financial planning, I implement total wealth management and help to ensure you, my clients, and my audience are well prepared for retirement, estate planning, and any exit strategy you choose. Connect with me anytime to learn how we can grow and protect your business value together. All right. So let's get into this. Today we're going to go through the 8 drivers, but from a perspective of Warren Buffett. So how increasing value to your business is using similar strategies that Warren Buffett uses to grow his business. We're going to go each value driver from the system of value, the value driver system that I use. I'm going to list the key element that you should avoid or the caution, a quote from Warren Buffett, and then some solutions that you might want to take a look at, or that you may want to reach out to me and I can help you go over it in more depth. So let me get this up for you. The first driver is financial performance. So the trap that we're trying to avoid is focusing solely on revenue growth without profitability. The quote from Warren Buffett: rule number 1, never lose money. I like that. Rule number 2, never forget rule number 1. I'm going to start using that from now on. Anytime someone asks me uh, uh, any market tips, I like to buy low, sell high, but I'm also going to say never lose money and never forget rule number 1. So that's slick. So, but yeah, the trap in the financial dealing with your financial performance is solely focusing on revenue growth without profitability. What does that mean? Not really looking down deeper into the numbers and how your business is performing financially. Potential solutions include improving record keeping. So hire an accountant, internal or external. I use an external accountant. She's still based in Central PA. I'm not an accountant, so this is something that I know uh, to strengthen my business. I need some outside help. Implement robust financial controls. You might want to have an audit, because auditors are the ones that identify where your weaknesses are in financial controls, especially if you have a large management team and a lot of employees. You definitely want to go through and put some money into having an audit to get a better look at your financial systems. Look at asset efficiency. So if you're in a company that has inventory, improving inventory management will help you with your bottom line. Optimizing the use of the equipment that you have. Look at profit margins. So working on cost structure. Negotiate better deals with your vendors. Look at your pricing strategy. That will better pricing strategy might cause clients or customers to buy more. Might increase your profit margin if you do it right. The next value driver, growth potential. So that's long-term future growth of your business. What's the potential? Anyone looking to purchase a business or invest in a business, and they want to find out how are they going to get paid back, how are they going to make their money, they start looking at your growth potential. The trap is overestimating future growth without having a solid plan. So you get a lot of these guys, and I see it all the time. They estimate, yeah, we're going to have 20, 30, 40% year over year. And I say, well, how are you going to do that? We're going to wing it. Well, they don't say we're going to wing it, but that would be a terrible way to market your business. But they don't have a good plan. Warren Buffett's quote: "The investor today does not profit from yesterday's growth." So there's a saying in finance that we use to warn investors that uh, yesterday's performance does not guarantee future performance in investments, and we have to say that all the time to people to let people know that your money is at risk. So this is Warren Buffett saying, "Hey, your money is at risk, especially if you don't have a solid plan." To enhance your growth potential, consider expanding into new markets. Now, that's geographic or demographic, or even new customer segments. So, I have behind me one of my marketing signs uh, for insurance producers. That's another customer segment of mine. They may be, some of them may be direct competitors, but they're also potential clients of mine, and helping them identify opportunities with their current clients or with new clients in advanced markets. Diversifying your product or service offerings. So, diversifying with complementary products or complementary services. Improve your business infrastructure. So, in terms of even management controls, uh, in terms of logistics, in terms of how you work, how everyone works together. Strengthen sales and distribution channels. One thing I'm doing is developing a sales team and hiring new sales executives into the business. The idea is to have someone that's focused on just selling. So I work on the first step, the business development, identifying new opportunities, identifying new potential clients and customers. I bring them to my sales executives. They make outreach. They market and sell the service. And then once the new accounts are opened, I come back and I work on the consulting. Leverage technology and innovation. So there's different ways you can do that depending on the industry that you're working in. I tell you, one way I am doing it is through my uh, privequity.ai business. It's a fintech platform for owners of private businesses. And basically, I'm taking this service of mine and I'm turning it into a SaaS platform using machine learning and artificial intelligence. My flagship AI is named Rory, and Rory is more than just a Chat GTP wrapper. Rory is a AI agent that can do wonderful things. So stay tuned for when I start bringing out Rory and using Rory for some of the business consulting that we do, some of the financial planning that we do, and putting it all together. This will make it more efficient and easier for people to make informed decisions. The next value driver is something called the Switzerland structure. And that's about the dependency that you have on any one employee, any one vendor, or any one customer. So if you have a customer that represents more than 10% of your total revenue, you have to work on that. That's too risky, because if that customer goes out of business or has any other type of business disruption, that's 10% of your revenue. And if your margins are tight, that could be huge. That could be devastating to you. So the trap: relying too heavily on key employees, customers, or suppliers. And where we have that, I'm going to stop the screen sharing. That's what I want to do. Uh, yep, customers and suppliers. Here's Warren Buffett's quote: "You only have to do a very few things right in your life, so as long as you don't do too many things wrong." All right, that makes sense. So as one thing might go wrong, that 5% that customer that represents 5% of your revenue may may have a business disruption or may stop buying from you. But then the next one that's 5%, you might start having some trouble covering some of your own costs. And then the next one that represents 5%, now you got 15% of your revenue that's not coming in. Let's say they were all down south during the hurricane season, and they had serious business disruptions. So they're not sourcing from you anymore. So again, the quote: "You only have to do a very few things right in your life, so as long as you don't do too many things wrong." That's a weird way to say things, but Warren Buffett, strange guy, Oracle of Omaha. Solutions include diversifying your supplier base. So having multiple sources for your resources. Also negotiating backup plans, having a plan B. So if this supplier isn't available, you have plan B. You already know how much they cost. You can just pick up the phone, make the orders, and get your product out. Cross-train employees. So if you don't want to be too dependent on that one employee that knows everything about this one topic, this one subject in your business, that's a key, that is the key that keeps your business running. Well, you want to train the rest of your employees at that level how to do that thing. So if that employee has, let's say they have an emergency and they have to take off for a week or even a few weeks, someone else can fill in for them until they get back. Develop and document your systems and processes. So it's important to have some sort of procedure, standard operating procedure, business wide, but for each of your different functions. And then manage risk through your contracts. So a lot of people, we talk about risk management, we talk about insurance, when we talk about accepting or retaining risk. One important thing, and I don't think the lawyers talk enough about how important they are in pulling this together, is managing risk through the contracts. So you can transfer risk right in your contract. You can diversify right in the contract. So you want to have strong contracts between your suppliers, strong contracts with your customers, and strong contracts with your employees. The next value driver is something called a valuation teeter-totter. So that's basically cash flow management. Cash is king, right? So the trap: poor cash flow management. And here's Warren Buffett: "I do not like debt, and I do not like to invest in companies that have too much debt, particularly long-term debt. With long-term debt, increases in interest rates can drastically affect company profits and make future cash flows less predictable." So he's talking about long term because Warren Buffett, when he invests, he's not investing for the next year, 2 years, 3 years, or even 5 years, or even 10 years. He's talking about 20 years down the line, and so his vision is just way out there. We want to bring it back a little bit because we're talking about small businesses, and you guys are dealing with day to day issues, month to month, year to year issues. So it's a similar concept, but more short term debt. Accelerate collections. So you want to get that cash in fast. These are additional solutions. Extend your payables. So if you could pay on the 30th, but it's not due until the 15th, pay on the 15th. All right, that's okay as long as you pay them on time, or negotiate for extended time. Tell them, hey, you know what? We pay after 45 days. We don't pay after 30 days, and get that into your contract. Back to making strong contracts, managing risk through contracts. Increase cash reserves. In personal financial planning, we call this an emergency fund. It helps you cover unexpected expenses or even opportunities. So if you come across an investment opportunity that will help your business, having that extra cash available that's not going to impact your working capital so much will really come in handy. The next driver is recurring revenue. So making sure that you're getting that your revenue is predictable and you'll be getting similar amounts on a regular basis, month to month, quarter to quarter, year to year. The trap is overlooking the quality of recurring revenue. So there's a scale of quality for different types of revenue. Warren Buffett, if you don't find a way to make money while you sleep, you will work until you die. So everybody that especially on the entrepreneurs, people who are in real estate, people that are out there the hustling to build their small business, they always talk about wanting to find ways to make money while they sleep. In real estate, you make money while you sleep because if you have a rental investment, office rental, residential rental, you can go to bed, you can go on vacation, and you're still going to get those rent payments as long as you did the right thing and made sure you checked the credit of your tenants, and you're going to make money while you sleep. If you don't find a way to make money while you sleep, you will work until you die. Warren Buffett. The solution: if you run a service business like mine, consider productizing your your uh, your service. So that's something that I've been working on. Doing that will make it easier to sell a more tangible product. It'll make it easier to scale your business. And with a defined process, like you'll be able to provide more subscription models or even have service contracts. Maybe one day in the future I'll have a video that discusses productizing your service. I don't know. I don't want to know if I want to share this with my competitor potential clients because then they might do this and put me out of business. Because if they manage to do it better, then I'm in trouble, right? Monopoly control. So this is dealing with maintaining your position in the market. If you go on Shark Tank, it's funny because they always try to talk about their market share, and they always talk about their market share, and we're like, well, you're a small business. There- you don't really have market share. What was it, like 0.0000001% of the market? That's not market share. That's zero. There's no market share there. But it's still important for you to position yourself in the market because you have to make your future and current clients aware that you're there and make sure that they know when they're ready to buy whatever it is you're selling, you're there and available to them, and that you have the best product, best service, or whatever you're doing. So the trap is ignoring competitive threats. All right. Warren Buffett says the key to investing is not assessing how much an industry is going to affect society or how much it will grow, but rather determining the competitive advantage of any given company and, above all, the durability of that advantage. All right. So, uh, from your perspective, where's your comparative advantage? Are you building it into the product? Are you building it into the way you present the product? Are you building it into your pricing? Um, how is that happening? And then what is the durability of that advantage? If you start doing this now, is everyone going to see what you're doing and mimic what you're doing and then catch up? Are you going to lose that advantage quickly? Or are you going to have to continue to innovate and adapt to maintain that advantage? That's what I get out of that quote from Warren Buffett. Here's some solutions for monopoly control. Differentiation from a marketing standpoint. All right. So look, I have a business consulting. Uh, I consult on value management, and I have some competitors that are also using this value builder system that I use. But those competitors aren't using it the way I use it because I use a value builder system plus due diligence and transaction support plus risk management Wealth management is my background, and I have a total wealth management package that's in my Evergreen Value Management system that helps business owners that want to manage the value in their business, manage the value in their accounts and financial planning, and be able to plan for the future. So my business is real different, and I believe I have a stronger advantage over my competitors. Develop proprietary technology or other intellectual property. So you guys know your business best. What can you do to do something that differentiates you, gives you an advantage? Technology is always an opportunity to do that, taking advantage of technological advancements. There are a lot of guys out there trying to get into the crypto and start accepting Bitcoin as payments. Is that something that looking forward, are we going to start using Bitcoin more as a currency? And are more businesses going to have to start considering maybe that's something that we should accept? We accept Visa and Bitcoin. Customer satisfaction. Now, the trap is neglecting customer feedback and loyalty. I'd say the trap is not not collecting customer feedback and not truly understanding the degree of loyalty you have there. The quote, it takes 20 years to build a reputation and 5 minutes to ruin it. If you think about that, you'll do things differently. So yeah, the people that we talk about your reputation and how valuable it is, but we don't really talk about why it has that value. And Warren Buffett is saying here, it takes 20 years to build that reputation. Whatever reputation you have, people know you as a stand-up person, integrity, values, open, you make good product, you provide great service. And even if you make a mistake, you're going to be there to help fix it and help keep everybody uh, working. And then 5 minutes to ruin it. And if you don't pay attention to the signs that your customers, that you're losing customers, that you're neglecting them, you're going to lose those customers. We use through the value builder system. We use the Net Promoter Score system, and then I also recommend, especially if you have a sales team, a dependable CRM system. There are a lot of them out there. I'm not going to name CRM systems, but customer relationship management will help you track where the customer is in the sales process, in your sales pipeline, or also manage after sale relationships. So keeping in touch, making those touch points that you're supposed to be making. Your CRM system will remind you, hey, it's December. You might want to start sending out those holiday cards. And then the last driver is the hub and spoke. So that's about the dependency that your business has on the owner. So the trap is having the business over reliant on the owner. Quote, I try to buy stock in businesses that are so wonderful that an idiot can run them, because sooner or later one will. So that's very funny. And I think if you look closely, watch CNBC or Bloomberg, you'll see there are quite a few companies that are being run by idiots, as Warren Buffett would call them, and they still manage to turn a profit. Over reliance on the owner means that in your business, we're talking about small businesses, lower middle market, and Main Street businesses. If something happens, you have a disability, you have an injury, and you have to go out on disability, Will your business survive if you take off for a few months? I mean, how long will your business survive if you take off for a week? Those are things that reduce the value of your business to you, because if your business won't survive, then it's costing you. You have to come in with an injury or figure something out to keep it going. But it also devalues the business in the eyes of a potential acquirer or even a lender. All right, they're going to wonder what will happen if this business, if you pass away. Um, yeah, you can have insurance, key person insurance on the owner, but that doesn't fix some of the other things. If you have specific knowledge that'll help run the business, then having key person insurance so the business can hire a replacement manager won't really bring back the original value of the business. So some solutions include business succession and continuity planning. For me, I have a combined succession and continuity plan. Because I got a small business, I don't need to have separate documents. Just squish it all together, and then I keep it with my estate planning documents, so that if something happens to me, uh, my wife can pull it, and as I grow the business, and I have senior managers, she will bring the document to them so they know what to do, or I'll have another file in the office for them to be able to peruse the continuity plan. So for this, we're talking about the risk of protecting yourself against the dismal D's. That's death, disability, dissension among the owners, or disaster. I think there's a whole list of potential dismal D's, but those are the big ones. And then there's the opposite of the dismal D's. So when I talk to people about enterprise risk management, I talk about risk management with the idea that, yeah, we want to protect ourselves against loss, but we also want to position ourselves to take advantage of opportunities. That's risk management on the upside. So we look at the opposite of the dismal D's, opportunities for growth. Having a plan will help you grow. Planning for your retirement, positioning the business. If you want to retire and your business is over reliant on you, I'm sorry, you can't retire, or you're going to have to let your business fail, or even something as simple as going on vacation. My wife always wants me to go on vacation, and I keep telling her, you know what? When I go on vacation, the business is over reliant on me. I can't just set things down and walk away. So I need to develop a system where I need to hire some managers. When I have my sales team, next step is to bring up some managers so that they're managing that sales team. When my sales team knocks it out of the park and produces to the point where my capacity needs growing, I'll be able to hire more advisors, and then I'll need managers for those advisors, and then those managers are going to be focused. They're going to be specialists, specialized sales manager, specialized consulting, and advisory supervisors. So then I'm going to need people to run the business, the finances, the marketing, the all the different aspects of my business, compliance, which is a big one for me since I'm in the securities business and an insurance business. I need managers for that, and then I'll be able to go away. So these are the jobs that I don't want to do. I want to delegate, so I got to hire some people for those jobs. Quick references, and then there's more. Uh, top 20, excuse me, top 25 quotes by Warren Buffett on A to Z Quotes. Let's see, that should be www.azquotes.com. 102 Warren Buffett quotes on life, success, and more. And that's on www.rule1investing.com. Warren Buffett, Wikiquote. So that's en.wikiquote.org. I'm just giving you guys the website, so you'll have to search this on your own. I mean, you can just Google Warren Buffett quotes and come up with tons of them. 100 wise Warren Buffett quotes on money and life. TheQuotesArchive.com. 25 best Warren Buffett quotes. The Motley Fool. You guys remember the Motley Fool? They're a throwback from the 90s. They're still out there. 8 best Warren Buffett quotes of all time. Money.usnews.com. Warren Buffett quotes his 25 best insights. That's on time.com, so Time Magazine. Warren Buffett on success and customer experience. And that's customer-service.com. Okay. So avoiding all the traps can help you align your business strategy with Warren Buffett's investment principles and enhance the value of your company. But beyond the 8 drivers of value, Warren Buffett also considers several additional criteria when evaluating potential investments. So I just wanted to go over that because I didn't want to give you the impression that this is it. This is Warren Buffett's playbook. These 8 drivers, game over. Now, there's more that he looks at. All right. Favorable long-term economic characteristics. So he looks for companies with sustainable, competitive advantages that can maintain profitability over the long term. We talked about that in monopoly control. Includes strong brands, unique products, or cost averages. Competent and honest management. He values companies with trustworthy and capable management teams. Buffett believes that good management can make a significant difference in a company's success. So he likes to avoid the idiots that running the company. Be prepared for it, but avoid it if at all possible. And from the investment banking perspective, when I was dealing with raising private capital, and even selling businesses, we looked at the management team and who's there to support the investor. Is this going to be a good team? Do they work together well? I think you watch on Shark Tank and see how the people interact with each other on stage as they're presenting. That's the shark's way of evaluating that management, at least the top management. Attractive purchase price. Buffett seeks investments that are priced below their intrinsic value. He aims to buy high quality companies at a discount, ensuring a margin of safety. So I use the Value Builder system to evaluate companies from the buy side, and I use that to identify opportunities for growth. So when we look at on the sell side, I look at, hey, if you want to maximize your net proceeds, this is what you need to do in your company over the next few months before we put it on market. On the buy side, I say, hey, you know what? This company, they should be doing these things. You could take this company and do these things and increase the value and make a profit just on increasing the value of the company. Industry familiarity. So Buffett prefers to invest in industries he understands well. This allows him to make more informed decisions and better assess the risks and opportunities. I find it funny. I remember during the financial crisis, Warren Buffett was criticizing the derivatives markets because he was like, well, these, how could you possibly understand? I don't touch these because I don't understand the investment. But he also owns insurance companies that operate in risk management and the derivatives market. So um, he understands, but I think he was pretending to not understand because he didn't really want to talk to those particular people, saying those people may not be the best partners to do business with. Consistent operating history. Companies with a stable and predictable operating history are more attractive to Buffett. He looks for businesses that have demonstrated consistent performance over time. This is why I bring up due diligence um, for companies, especially if you're planning on selling or raising capital, or even going out and borrowing funds. You should do a internal due diligence, and I can help you with that. But that internal due diligence, we look at your operating history, and then we gather records to ensure that whoever's looking at your company, you can say, "Hey, yeah, my company has strong operating history, and here's the proof, and it has strong prospects, and this is why we believe that it does. We have this plan, and we have this proof." Strong return on equity. Buffett favors companies with a high return on equity, as it indicates efficient use of shareholders' funds to generate profits. So I, a lot of these guys get up and they say return on equity, but they don't really explain what they're looking at. I suggest you just Google the DuPont analysis and do some research on how, if you break out, decompose, or deconstruct return on equity, um, how you get some indicators of how the company is performing through a DuPont analysis. Low debt levels. He prefers companies with manageable debt levels. High debt can be risky, especially during economic downturns. So Buffett looks for businesses with strong balance sheets. Strong point, he doesn't say no debt. So a lot of people, especially single investors, individuals, but also small company owners, look at their business and say, "I have no debt." That's a good thing, right? No, because now you're taking on all the risk on yourself. If you have no mortgage and and your property burns down, then that's all on you to replace. No one's going to help you. Um, you want to have well managed debt, but too much debt can be risky because the payments that you have to make, the fixed payments that you have to make, don't change month to month, quarter to quarter, year to year. And if your revenue changes uh, because of, or if your net profits change because of your gross profits change because of inflation, you're not going to be able to cover those payments, and that could put you out of business. So he's talking about managing the debt in a way that you manage the risk against managing the debt against managing your cash flow. Profit margins. Buffett examines profit margins to ensure the company is operating efficiently. Higher margins often indicate a competitive advantage and effective cost management. There's more to look at than that. I think the profit margin. Buffett is right. Profit margins are important, but higher margins can also, from my analyst mind, saying, "Well, are they buying cheaper materials? Do you want to cross a bridge that was built on the weakest steel or the best steel? The weakest, cheapest steel or the best steel that's a little bit more expensive?" Um, so the company that built that bridge on cheap steel or less skilled labor, yeah, they had a higher profit margin, but then there's other risks involved that weren't accounted for. So profit is important, but it's not everything. I mean, it's the goal to have profit, but it's not the only thing that affects whether or not this business is a valuable business company. Competitive advantage. So he looks at, again, that's the moat. And we talked about that earlier. A strong competitive advantage or moat is crucial. This could be the form of brand loyalty. So if you know your clients or your customers will continue to come back and are going to refer you all the time, then it will be hard for a competitor to get in there and take your business. Network effects or cost advantages. So if you can provide good quality materials at low cost, and then because you have low costs, you can price a little bit more competitively. That can help you build a moat as well. By considering these, Buffett aims to invest in companies that are not only undervalued, but also have the potential for long-term growth and stability. So let me review these references for you. www.fool.com. Warren Buffett's 4 foundational criteria for major investments. PicturePerfectPortfolios.com. Warren Buffett's investment criteria and in-depth analysis. www.investopedia.com. Buffett's 3 best rules for stock investing. Investopedia.com is a very good resource. I like them. And I visit that site quite a bit. One of the things about being a consultant and being a financial advisor is speaking the language of your clients. And so I can go and I need to go to sites like Investopedia or you might laugh, but Investing for Dummies or some book like that, because I need to make the language something that normal people can understand, not finance nerds like me. Okay. So that's it. That's Boss Moves. 8 value traps to avoid in small business. Look for me on Thursday when we do the personal finance portion. And then I will do this every Tuesday. I'm going to tell you that in a couple of weeks toward the end of this month, I'm going to pre-record this. So you might notice a better quality videos for a while because I'm going to put pre-recording. I take off toward the end of the month for the holidays. And then I also spend a week on business planning for the next year, for 2025. And I suggest you do that as well. Thank you for joining me on Boss Moves, and I will see you, if not Thursday, then next Tuesday.